You are now in medieval France, somewhere around the year 1100. You're a farmer. You have a small piece of land that your father gave you and his father gave him before that. That land is not just your home. It is your food. It is your security. It is the only thing standing between your family and complete destitution. And right now, you need money desperately. Your roof is collapsing. Your livestock is sick. The winter is coming and your grain store is dangerously low. So you walk to the local lord, the wealthy landowner with the power and the resources you do not have, and you make him an offer. You pledge your land as security against a loan. You will keep living on it, keep farming it, keep feeding your family from it. But if you cannot repay what you owe, that land, the only thing your family has ever owned, belongs to him completely and permanently. The Norman French lawyers who wrote that agreement into legal language called it something that most people today pay every month without ever knowing the meaning of. They called it a mortgage. 2 words, mort meaning death, gage meaning pledge, a death pledge. Not because they were being dramatic, not because they were trying to frighten people, but because the arrangement ended in one of only 2 ways. Either the debt died when it was fully repaid and the pledge died with it, releasing your land back to you, or you died still in debt, still pledging, and your land died with you, transferring entirely to the lender. The pledge only ended at death, yours or the debt's, whichever came first. That word, that death pledge, traveled from medieval French into Middle English, shortened and simplified, and became the word you use today when you talk about buying a home: mortgage. Every single time you say that word, every single time you sign that document, every single time that payment leaves your bank account, you are using a medieval French legal term for a contract that ends in death. And the system it describes has not changed nearly as much as the people running it would like you to believe. Now go back even further. You are in ancient Rome around 2000 years ago, and the Romans, who had a legal framework for almost everything, had already developed an early version of the mortgage that they called hypotheca. The hypotheca worked differently from what medieval Europe would later create. Under Roman law, when you pledged property as security for a debt, you kept full possession of it. You still lived in your house, you still farmed your land. The creditor did not take anything physically from you while you were paying, but the legal claim over that property sat with the lender like a shadow, invisible, silent, patient, and the moment you failed to repay, that shadow became real and solid, and the property transferred to the creditor immediately and completely. The Romans were sophisticated enough to understand that making a debtor homeless immediately was counterproductive. A farmer who keeps his land, keeps farming it, keeps generating income, and therefore keeps the possibility of repayment alive. A farmer thrown off his land the moment he falls behind has nothing left and can repay nothing. The hypotheca kept the debtor functional just long enough to either repay the debt or exhaust every possibility of repayment before the inevitable happened. 2000 years later, the principle of allowing a debtor to remain in possession while a lender holds a legal claim over the property is still the exact foundation that every modern mortgage in the world is built on. The Romans thought of this in the time of Julius Caesar, and it has not been redesigned since. But here is where the history of mortgages takes a turn so dramatic, so dark, and so human that it reads like something from a novel rather than a financial textbook. In medieval England and feudal Europe, land was not simply property, land was identity, land was class, land was freedom itself. A man who owned this land was free. A man who lost his land to debt did not simply become poorer, he became something closer to a slave. Without land in the feudal system, you had no choice but to become a serf, a person legally bound to work another man's land for the rest of your life in exchange for the bare minimum required to survive. Debt in the medieval world was not just a financial condition, it was the entrance to a form of permanent servitude that passed down to your children. And the lords who issued these debt arrangements understood this perfectly. They designed the terms to be difficult. They charged rates that made full repayment a genuine struggle, not because they were cartoonishly evil, but because a borrower who was perpetually close to repayment, always working, always producing, always just managing to service the debt without ever fully clearing it, was the most productive and most controllable kind of tenant imaginable. The mortgage in its medieval form was not just a financial tool, it was a social control mechanism, an understanding that changes everything about how you look at the modern version sitting in your own name right now. Now, here is one of the most shocking and most overlooked facts in all of American financial history, something that will completely reframe the concept of home ownership as you currently understand it. Before 1934, less than 100 years ago, the 30-year fixed-rate mortgage did not exist anywhere in the United States. It had never existed. Before Franklin Roosevelt's New Deal created the Federal Housing Administration in 1934, American mortgages were almost nothing like what you know today. They were short-term loans, typically 5 years. They required down payments of 50% or more of the purchase price, and at the end of the 5-year term, the entire remaining balance of the loan was due in one single payment called a balloon payment, not monthly installments spread across 3 decades, one enormous lump sum at the end of 5 years. For most ordinary Americans in the 1920s and early 1930s, home ownership was simply not possible. The financial structure of the mortgage system at that time was designed for people who were already wealthy, people who could produce a 50% down payment and still have enough liquidity to handle a balloon payment 5 years later. The idea of an ordinary working family buying a home with a modest down payment and paying it off gradually over a lifetime, the dream that millions of people are chasing right now, was invented in 1934 by a government program created specifically to pull America out of the Great Depression by making home ownership accessible to ordinary people for the very first time in history. The American dream of home ownership is not ancient, it is not traditional, it is 90 years old, and it was created by a government policy. You are back in the present, and if you have a mortgage, or if you're planning to get one, or if you dream of one day owning the home you live in, there are things happening inside that document that were never explained to you. Things that cost you tens of thousands of dollars over the life of the loan while looking completely normal and reasonable on the surface. The first thing you need to understand is how a mortgage payment is actually structured, because almost nobody explains this clearly, and the ignorance of it quietly costs the average homeowner a staggering amount of money. When you take out a 30-year mortgage, your monthly payment is split between two things: the principal, which is the actual amount you borrowed, and the interest, which is what the bank charges you for lending it. These two amounts are not split equally, not even close. In the early years of a 30-year mortgage, the vast majority of every single payment you make goes to interest. Almost nothing goes toward reducing what you actually owe. In the first year of a typical mortgage, sometimes as little as 20% of every payment you make touches the principal. 80% goes directly to the bank as interest. This means if you buy a $300,000 home and make 12 payments in your first year, you have likely reduced what you owe by less than $5,000, despite paying many thousands of dollars in monthly payments. This structure is called amortization, and it is calculated specifically to ensure that the bank receives the maximum amount of interest from you in the years when you are least likely to refinance or sell. It is not random, it is not an accident, it is designed. Here is a number that will stop you completely. On a $300,000 mortgage at a 7% interest rate over 30 years, you will make total payments of approximately $719,000 by the time the loan is fully paid off. You borrowed 300,000, you paid back 719,000. The bank made $419,000 from your single home purchase, more than you borrowed on one house over 30 years. That is a death pledge in its most modern and most expensive form. But now here's the part that gives you real power over the system, because the amortization structure that front loads interest in your early years also means that any additional payment you make toward the principal in those early years has an enormous impact on your total cost. Paying even one extra mortgage payment per year, just one, on a 30-year mortgage can reduce your loan term by 4 to 6 years and save you tens of thousands of dollars in interest. Not because of any financial magic, simply because every extra dollar applied to the principal in the early years eliminates multiple future dollars of interest that would have compounded on top of it. The medieval French farmer had no way to escape the death pledge once he entered it. The terms were fixed, the Lord held all the power. The document owned him until the debt was cleared or he was gone. But you are not a medieval farmer. You have options he never had. You can overpay, you can refinance when rates drop, you can make strategic extra payments that collapse a 30-year loan into 20 or 22 years and redirect the years of payments you save into investments that grow your wealth instead of the bank's. The death pledge only kills you financially if you follow the default schedule the bank designed for you without ever questioning whether a different path through the same document is available. The word mortgage has been part of your vocabulary your whole life, but now you know what it actually means. A death pledge, designed in medieval France, refined by Roman lawyers 2,000 years ago, repackaged into a 30-year product less than 100 years ago by a government trying to stimulate an economy, and currently sitting in the name of millions of people who are paying $400,000 on a $300,000 home without fully understanding why. The pledge does not have to end in death, it can end in knowledge, and you just received it. Subscribe to Money Through the Ages, because next time we are uncovering another ancient financial word hiding in plain sight in your daily life, and what you find inside it will completely change how you see your money all over again.